Welcome back. Now, Kumba Iron Ore has delivered a resilient full-year performance underpinned by firm iron ore prices, disciplined cost control and a strong cash position. This even as free cash flow and dividends eased from elevated levels seen previously. Revenue edged higher, margins expanded and the group closed the year with a robust net cash balance, highlighting operational resilience in a volatile global trade environment. CEO Mpumi Zikalala joins us now to unpack that performance. Mpumi, thank you so much for your time today. Before we get into the numbers, I'd like to get your read on the iron ore market. Prices were softer in the first half, recovered in the second, and have softened again early 2026, with some analysts even flagging a challenging medium-term outlook. How are you viewing that? How are you reading that?
Thank you for having me in Tauleng. So the iron ore markets have been interesting. So leading into 2025, people were actually quite pessimistic around how things were going to pan out. And interestingly, if you look at the year, prices were stronger than what people expected. Yes, they were weaker relative to 2024, but they were certainly stronger than what people expected to see. And a couple of factors were at play. We certainly saw reduced levels of steel production in China, but if you look at the reasons why, there was a greater level of reduction in terms of steel that comes from electric arc furnaces, and these typically use more scrap relative to what we saw from a blast furnace perspective. And clearly, when one looks at Kumba's ores, we are still well positioned for blast ore furnaces, because the quality actually assists our operators, or actually it assists our customers when it comes to how they operate their fundamental businesses. So if you look at last year, we're very pleased with the results. So our average realized FOB price was actually 12% above the benchmark at $95 per ton. So we earned premium by virtue of both the quality of our ore, and then secondly, by also virtue of, I have to say, the strength of our marketing team, who go all out into the different markets to get us their best price. If one then looks at how the year ended, yes, it was stronger more broadly, but we started to see the softening of the lump premium, and we've clearly got huge portions of our products being made out of lump. We are starting to see the recovery of lump, but it's still lower than what we expect to see for the remainder of the year. We understand why there was a reduction. From a supply perspective, we saw additional supply coming in from both Australia and Brazil. But we have started to see more people using lump, and coming out of the Chinese New Year, we expect to see further strengthening, with lump being forecasted to essentially sit within the range of the 15 cents to 20 cents per DMTU. The steel industry perspective, just the broader industry, people have been talking about the softening and the fundamentals around that. I'll end it off by saying that from a Kumba perspective, we focus on the production of high quality iron ore, which makes sure that even within the, I guess, challenging space that we find ourselves in, we continue earning premium, and we are still seeing that right now.
Now, Mpumi, you touched on China there, and that market continues to account for a growing share of exports. But of course, Kumba has set a target of lifting volumes to other regions to 45 to 55%. What concrete steps are you taking to diversify your customer base and expand further into markets like Europe and other Asian markets?
So the wonderful thing with our business is that we focus on the production of high quality iron ore.
Yes.
And as I've said, we focus on predominantly lump, which makes up 2/3 of our products. Now, China is an important market for us, but we've already spoken about the 45 to 55% range and said that we'd like to see ourselves selling 55% in other markets out of China. Clearly, if one looks at the dynamics for last year, we saw a reversal of that. But what was interesting, Tauleng, is that, you know, if one looks at the first half of the year and the second half of the year, we certainly saw ourselves having a greater share of products going into other regions. What are we doing going forward? We will be strengthening our product portfolio going forward, post the UHDMS product or project, which will increase our share of high premium products which are desired in other markets.
Those ambitions, of course, are also linked to, logistics, right? Transnet stabilization has also started to show in your numbers. We did see revenue up 2%, production also up 1%. Talk to me about that. And, you know, there was a reconfiguration within the business to manage those logistics constraints. Does the improvement we're seeing now open the door to even more production?
So firstly, we are excited by the fact that we are seeing greater levels of stability at Transnet, but that still translates to only 84% of our contracted volumes.
Okay.
And when one looks at our reconfiguration of the business, we had it in mind that the full recovery back to our contracted volumes will take a couple of years, simply because there's still a lot of work that needs to be done. So if one looks at where we are still well matched. But I've always said that if we see a faster phase of recovery, we'll definitely be able to match that as a business. But for now, I think we are well placed, and we will continue working with Transnet just around the execution of their ore corridor restoration program.
Let's talk about operational efficiencies now. While costs are coming down, investment continues. Mpumi, CapEx guidance sitting between 13.2 to 14.2 billion rands, with significant spent on that technology project, the UHDMS. Can you just update us on the progress there and when shareholders should expect to see some tangible returns?
Yeah, it's an exciting project. So we continue investing in this project, and it forms the lion's share of our growth capital expenditure. There's also a smaller portion that's going into exploration and studies as we look at expanding or extending the life of our mines. The project is in an interesting phase this year because we will be doing what we call the main tie-in of all the various sections. So we will stop the DMS plant as we execute this. And I'm very proud if I just look at where our teams are with regards to this preparation, considering that the work will start in August. The other element of the growth from a capital perspective is linked to the recapitalization of our heavy mining equipment fleet.
Yes.
So we are going through a replacement cycle, and we segmented that. And clearly the value of doing that is that when you've got a new truck, it actually means that you spend a lower amount on its operating costs, and it means that you get greater efficiencies. So again, we'll see a return in terms of that investment. Just back on the UHDMS itself, it's got an EBITDA margin of 50%, and it's got an IRR of 30%, and its payback post-first production is only 3 years. So it's a good project.
All right, let's leave it there. Mpumi, thank you so much for your time and taking us through the year that was for Kumba. That was Mpumi Zikalala, CEO of Kumba.